Hi, everyone, and welcome to The X, a podcast from inside Silicon Valley about how experience shapes everything, from products to businesses to entire industries. I'm Bryan McLean, and I'm here with Demetrius Madrigal. Today, we have a special guest and an old friend on the podcast. Ryan Else is the managing partner of Roadster Capital and a longtime technologist and friend. He's on the podcast today to discuss all things venture capital and his outlook on the industry and explain how it all works. We have a lot of questions for him, and we hope you enjoy this conversation. Welcome, Ryan. How you doing?
Hey, Bryan, I'm doing really good. How are you today?
I am doing great, man. You know, it's been a long time since we've seen each other in person, but I'm happy we've stayed connected all these years.
Yeah, it's not just COVID, right? It's a lot more than that for us. We've just been in different places at different times.
Exactly. Yeah. I mean, for all those who are listening, for some context, Ryan and I actually met back in 1999 in San Francisco during the first dot-com boom. And we worked for a company called Turbo Linux. Between the 10-hour days of hard work and also spending time, outside of work and hanging out and having fun and exploring the city, we just became good friends. And I actually remember, Ryan, coming to your apartment one night and you were showing me your drum set and kind of teaching me how to use it. I remember you told me, you're like, you have to wear headphones because my neighbors are like so irritated with the drums. And I just remember having a lot of fun times in the city back then. I mean, how do you feel when you recall those times back in the late 90s before the kind of bust of the dot-com time?
I have really fond memories of all of those times. I mean, right prior to Turbo, I was at PeopleSoft, and we were selling Y2K solutions because everyone was concerned that all of the money in their bank accounts was going to disappear, and companies were considered that the zeros and ones were going to run out, and so we were selling all of these different types of processes to go in there and check out these enterprise systems and make sure that they weren't going to fail and assure CTOs that they were going to be safe and we were going to protect them. So yeah, it was a wild time, but lots of fun at the same time. Turbo was always a great time too, and playing softball with the group and just learning all things about Linux and the kernel and what they were trying to do there was an exciting time for me. It was something very new to me. I didn't know much at all about Linux going into that role, but
Yeah.
I sure did learn a lot along the way.
And I have to tell everyone the truth about something. So when I got that job, working in the IT department and helping out, I was very young and I was very into computers and things like that. But my Linux exposure was light, and so right before I actually started, I went and got every book I could on Linux, and I like read them all like cover to cover, and like set up machines at home and all this kind of stuff. Like literally 2 weeks before I started the job. And then when I got there, I realized that there was like the hardcore Linux people that were there. And then there was everybody else, like the rest of us, that were actually still trying to learn this stuff as it was evolving. And so I really wasn't alone in this. Like when you said, like, I didn't know everything about the Linux world, like neither did I, and neither did the majority of people that were around me.
Yeah, no, I
And
like my background at the time was like relational database management systems and
yeah. And, I have a question. At the same time, you were also doing extras. You were an extra on movies. Is that correct? Like, I remember you doing some fun stuff. And I actually have a still shot, can't find it on my computer somewhere, from, I think it was The Pursuit of Happiness. From when you were in that movie. Do you still do that? And what got you into that back then?
wow, I didn't expect that to come up. All right, so when I was a senior in college, I was an intern at Oracle, and an alum from my undergrad had come to visit, and
Uh-huh.
a guy I went to college with, Julio Iglesias Jr., and I were pals, and a professor said, "Oh, you should meet this guy who's in town, and he represents a bunch of people in Hollywood." So I had lunch with this guy. He was in town because he represented big name actor. I won't. Oh, Sean Connery. He represented Sean Connery,
Oh, wow.
and the Rock was being premiered in San Francisco. That's where they escaped from Alcatraz.
Oh, I
And
love
he
that
came
movie.
into
Yeah.
town with, of all people, Lori Loughlin from Full House,
Oh my
the one
God.
who most recently served time for helping her kid get into USC. So I got to have lunch with this guy, and it just kind of piqued some interest. But I was still, I was thinking I'm going to be a corporate warrior for the rest of my life. That's what I'm going to do.
Yeah.
And I went to audition for a movie, and I didn't get the role. And then out of nowhere, this casting agent calls me back and says, "Oh, I've got the opportunity for you of a lifetime. You're going to be a perfect fit." and I thought the guy was pulling my chain. So I called the guy down in LA that I had lunch with, thinking he'd never get back to me. And he did. And he said, "Oh, yeah, you should go." So I showed up on set. I skipped out on my internship that day, in my senior year for a day. And I went on set of a movie called Ed TV.
Oh yeah, I remember that. Yeah.
And they had called ahead and let production know that I was coming. And I showed up and they said, "Oh, hey, Ryan, we've been waiting for you. Come on back here." And we were in North Beach and they took me in the back of this church where there were a bunch of people eating and sat me down at a table with like Ron Howard and Woody Harrelson
No way.
and Matthew McConaughey. And McConaughey wasn't really anyone big at the time, but I knew who Woody Harrelson was.
Yeah.
And I knew who Ron Howard was, but I was still kind of a young kid at the time, really. I was 20, let's say. And when the movie came out, the only slow motion scene in the movie was a close up of me on Matthew McConaughey going back and forth, like filming him as he crossed the street in one of these scenes. And ever since then, my phone would ring with random opportunities. And I did so many of them that I was approached by a casting director who said, "You can do more, but you have to join the Screen Actors Guild. And if you don't, then you can't do any more, or you won't get paid the rate." So I joined the guild and I've been a member of the Screen Actors Guild for longer than I can remember. It's never paid the bills, if you will, but it's always been a lot of fun.
Oh, I mean, yeah. I mean, the stories that you have, and I remember you showing me stills from different things and stuff. And it's like, what an adventure. I mean, when you think about, obviously you've had a very adventurous career as well, and you've done some amazing things, and you're doing even more amazing things now. But like to weave in some of the fun as well, it kind of says a lot about your personality, Ryan. Like you're willing to kind of like go the extra mile and try something new or something interesting and kind of explore an industry like you did there, and at the same time still keep the train moving on the stuff that you said, you wanted to do kind of for the rest of your life. And I am a bit curious, like I lost track of you a little bit after Turbo Linux ended. So when Turbo Linux ended, I went and took a job actually at NASA, and then I went back to school to finish my master's degree, my undergrad, and then my master's degree. And you and I lost touch for a while. So can you kind of give us an idea of what your story was leading up to you building Roadster Capital, starting back after Turbo Linux went under, and then you moved on?
Yeah, I moved on, worked at a couple other startups in the field of network and application security, and built a really strong network within that realm, and still work closely with a number of people from those companies that I worked at. And over time, I eventually went back to school and earned a master's degree in business and finance from University of Notre Dame. And then I started a company, co-founded a company, I should say, that did pretty well manufacturing products in the consumer goods space, and had a decent exit, but nothing truly life changing there. And then eventually found myself leading a global turnaround for a large consumer electronics manufacturer based in Hong Kong, and split my time between Hong Kong and Portland, Oregon. And along the way, I was making investments. So that consumer electronics company was focused on connected devices, weather stations, and IoT connected devices and other products. So my interest was always leaning heavy into tech. I was always looking for a way to invest more formally, if you will, in
Hmm.
startups. And I knew there was a way to do it. Just my trajectory just didn't take me straight into VC right out of the gate. It just happened later in my career after having a long stint as an operator as well as an angel investor in some companies that did all right and had decent markups.
So let's pause there for a second because there's a couple things that you had mentioned that I think are really insightful. So nowadays, I do hear every once in a while that people will go directly out of their degree, like whether it be a finance degree or an MBA or something like that, right into a VC firm and then kind of learn within the firm itself. But it seems like the majority of people I meet have a background a little closer to yours, where it's like you started a company and you went through the pain and discomfort and excitement and all the things that are kind of built around starting a company. You also worked for a company where you had to spend time in China, in Hong Kong, and then here, and it's like a lot of that life experience kind of plays into helping other entrepreneurs, and also making smart and strategic investments, in my opinion. Do you feel like those life experiences have kind of really led you to where you are right now and are helping you in what you're trying to achieve with your company?
Yeah, they have definitely helped me in ways that you can't really even put down on paper. And, life experience is probably the most valuable experience of all. There's definitely a lot of value to those people who are pure finance individuals and they have a really strong finance backgrounds and they start out at a venture firm early in their career and stay there. But
Yeah.
the people in those roles don't have strong operational experience. So you'll see these people's LinkedIn bios and they say that I'm on 10 boards. They go and sit in these board meetings, but they don't have a whole lot of value that they can add in those board meetings in some
Hmm.
cases, especially if they're more junior. They're
Yeah.
really there just to report back to the GPs at the firms they work for and tell them this is what we saw in the meeting and this seems to be the state of the business. It seems healthy, or the boardroom was total chaos. We need to get in there and fix things up.
Yeah.
And then they will. A lot of these venture firms will have experts, if you will, in different fields who they reach out to for knowledge, if you will, to get in there and help them make clear decisions. And they have really strong teams around them that enable them to do so.
Hmm.
But for me personally, my path just didn't lead me straight there.
And I think that's okay. Like the things that you've done, it seems like you've built an amazing career up to this point before even starting your venture firm. So it sounds like, you're kind of bringing all of that kind of insight and education and everything to what you're doing now. So let's kind of, fast forward to your company. So Roadster Capital. First off, like, why did you want to start your own VC firm versus, let's say, going to work for one, or, being kind of on the sidelines as just an investor, but not actually like running the firm itself?
Well, I thought that there would be an opportunity for me to change the landscape of venture as a whole and really drive my own personal values into companies that I invested. And I felt the
Hmm.
best way for me to be able to do that was to be through a firm where I built that culture from the ground up rather than working for a firm where something already existed and the ability to implement change would be much more challenging. There was also a lot of talk at the time that still continues about, you know, the toxicity of male dominated Ivy League dominated venture capitalists always
Hmm.
investing in the same person or someone who looks like them or sounds like them. I found that to be troubling, and it wasn't something I really wanted to be a part of. But at the same time, maybe it would have been an interesting move. But for me, I'm always one to strike out on my own and look for the opportunity to do something big and then bring good people around me to help me execute on that vision in a more cohesive way. So there've been a lot of learnings along the way in getting Roadster off the ground, but this is an opportunity for me to really, put values first in all of my investments and be sure that the companies that I'm investing in are companies with founders whose real core vision is to make the world a better place while
Yeah.
also driving outsized returns for me and my investors.
Yeah, and that's a big undertaking. I mean, starting from scratch and kind of building your own firm, your own reputation, like all that kind of stuff is a big move forward. And one of the things that I find on a lot of these podcasts and interviews and things like that is nobody ever properly defines like what it really takes to start your own venture firm. And so I was wondering if you could, with some detail, kind of give us an idea. So, like, let's take an example. Let's say that you're a technologist, you work in Silicon Valley, and let's say you had some really great exit, and you have a percentage of your money, and you're like, you know what, I think I want to start my own firm. I want to start with my money, and then kind of go from there. What does it take to get it off the ground? Like what do we need to do to make that a reality?
Well, that's a good question. In most cases, it takes a miracle or it takes a very deeply connected network of incredibly high net wealth individuals that can write checks for you fast for you
Okay.
to manage. But if you're going into this blind, as a number of people do,
Yeah.
you come to learn that it's not easy at all. I mean, and you'll meet founders who are starting startups, and they'll say, "Gee, why is it taking you so long to raise money for your venture fund?" And the response is, "Well, it's a whole lot different. There's a different level of diligence that an investor in a venture fund puts the manager of that fund through
Hmm.
than there is the type of diligence that goes into investing in your startup." And it's because there's a number of different reasons. Everyone has their own, but it's just far more challenging. There's also a lot more legality involved. There's a different level of fiduciary that's involved. And then the type of investors or limited partners into venture capital funds is different than an angel investor writing you $1,000 or $20,000 into your friends and family round. We're
Yeah.
looking for people who are investing at minimum 500,000 to $1 million per check into our venture fund.
So, what is the difference then between an angel investor or a limited partner?
It's changing by the day
Oh, okay.
because there's so much dry powder out there. The stock market over the last several years has done so incredibly well. There's an incredible amount of dry powder out there that large institutions and family offices have.
Hmm.
So, um, the rounds change. There's an angel round typically, which would be a friends and family round, if you will, and then it would move from there to a seed round, and then from there you'd move on to A, B, C, D, and on. Angel investors could be is anyone with a relatively high net worth who's able to write a check for you into your business,
Hmm.
directly to you into your business. And then
Okay.
a limited partner is someone who's writing a large check into a specific venture fund that will build a portfolio of companies on their behalf within the fund.
I see. So, who
So
are they typically?
angels will like selectively pick one by one investments, and they manage it all on their own. And limited partners are either like formalized entities, pension funds, universities, endowments, or very high net wealth individuals who will write a check to a general partner at a venture fund, and that check is given to them to act as a fiduciary on their behalf to make investments on their behalf. So then they're not managing every individual investment. They just have someone that's essentially a money manager on their behalf.
Okay. So then, let's say a pension fund wants to invest into your venture fund. When you go and pitch to them, like, hey, I need, or I would love for you to write a check for 1 million or 10 million or 100 million, right? What do you have to provide to them to build the confidence for them to want to make that investment? Because they know that the investment with you is going to be risky, right? Because it's a venture investment. These are new companies being built, coming off the ground, could take 10, 12 years before they fully materialize, right, into something that's valuable. So, what do they look for from you?
Well, they look for a number of things. I think they all have their own different pieces of value that they're looking for when they make those investments. Traditionally, they're looking for more seasoned. They're looking for well seasoned funds that are beyond fund one, like say maybe fund three or fund four. And
Hmm.
then a fund that is raising fund one is an emerging fund. It's a new fund. And if the manager of that fund is an emerging manager, the likelihood of them investing is lower than that of investing in a fund manager who's coming from a name brand fund prior to this that
Hmm.
was allocating capital in the past. Now, what they will look for in emerging managers and new fund managers is track record. They want to
Okay.
see how have you invested in the past? What are the outcomes of those companies that you've looked at? They're very curious to see the level of deal flow. One thing that they want to know that most new entrants who know nothing about venture funds, one thing they want to look at is your understanding of portfolio construction
Okay.
and how you plan to allocate the capital that you're looking to raise. That's a really critical component that you need to be willing to speak about clearly. when talking to a limited partner.
Yeah, and these limited partners get pitched all the time, correct? Meaning all the funds are probably hitting up all of the pension funds and the endowments and things like that. So they're basically looking at each one of these venture funds and saying which one fits best with our goals, our ideals, and what we're hoping as an output, right, from the venture fund itself.
Yeah, if they do invest in venture, they all have different mandates and objectives in those funds that they invest in. So some may be looking to invest in impact. Some may be looking to invest in diverse managers. Some may be looking to invest purely in software. Others might be looking for venture funds that are only investing in consumer goods. I mean, you can run the gamut. So, yeah, and these pension funds typically, if you're pitching a pension fund, you're raising like $100 million plus fund because usually it's difficult for them to write a check under 10 million
Hmm.
into a venture fund because they're managing billions of dollars. So it doesn't make sense for them to bring on a micro fund that is, anywhere from 10 to $50 million because the size of check they'd have to write to pencil it out, plus all the back office and the management of that relationship doesn't really add up for them.
Hmm.
So those are they're really more or less investing in more established, larger funds.
Is it common to find venture funds, specifically new venture funds, that don't have many partners connected to it? It's just like a single individual who maybe had a windfall and just wants to make investments into companies that they believe in? Or is that more of like a
It's
rarity?
becoming much more common. It's a newer trend that we're starting to see. But yeah, I mean, more often than not, you're going to see a venture fund with two partners or more.
Okay. What's the benefit to trying to grow and become one of those big ones versus kind of staying small and very nimble, like I believe you're trying to do as well, right?
Yeah, I'm looking to stay small, nimble out of the gate, and then we'll grow the firm and grow AUM over time,
Uh huh.
which is a smart way to do it. Firms that are larger and have more AUM or assets under management, they need to have more than one partner in most cases because it doesn't make a whole lot of sense for any single individual to manage, more than say 30, $50 million at the most because you're allocating money into each of these companies. And if you intend to be rolling up your sleeves and helping these companies go,
Hmm.
um, depending on how your portfolio construction is put together, it doesn't make sense for you as an individual to be running over $100 million and investing into, you know, 40 or 50 companies, which would be a huge portfolio and very challenging for an individual person to manage. There's
Yeah.
so much paperwork and going on.
Yeah.
For us, we're building a portfolio of like 25 companies.
Yeah.
But it makes sense to add partners as your AUM grows so that you can better assess the market. So you have people that you can, bounce ideas off of so that you can extend your network. And so you have different perspectives and point of views on each opportunity so that you can talk to each other about it. But
Yeah.
a sole founder or a sole GP in my case will have either an advisory committee or advisors to the fund that you lean into, and in some cases you share a portion of your carry with them to compensate them for being there for you so that you make sound decisions along the way, and you don't go too far off of your target.
I mean, that makes a lot of sense. And I've seen it done, obviously all these different ways. And one of the big debates that I was hoping you can kind of weigh in on is that I've talked to a lot of founders and a lot of individuals that have been in the industry for a long time. And they always have kind of a different opinion on this is that what is the venture firm's role once they've funded you? So, how much should they be assisting you, advising you? Like, where does that line get drawn? Right. So, once that check is written and you're like, great, thanks for the $2 million. I have my, strategic plan. We're going to move forward. I got my team, that kind of stuff. what else needs to be done, or what else needs, I guess, assistance or help from the venture firm after that check is written?
Well, from my perspective, some funds are focused on helping you hone in your operations or build out sales, or they will say, our core expertise is, we understand recruiting and we understand engineers and we can help you recruit in the earliest stages of your company the best engineers in the world to drive your business forward and help you achieve greater market share and build out a GTM strategy that makes sense. As companies get larger and more funds come in writing bigger dollars, I think your real hope is that you start getting name brand funds latching onto your round who have networks that are equally as deep as their own and can
Mhm.
help you bring in capital across the capital stack then and in the future.
Yeah, I mean, that makes sense. I sometimes think of it as almost like a service company on top of an investment company, because you're providing the investment. And I think people always think of it from that perspective of just like, hey, Roadster Capital just wrote me this, $500,000 check. But then at the end of the day, like, Ryan can pick up the phone and call five or six engineers that he knows that are really successful and really, competent, and say, hey, you should interview with this new company. I think they're doing big things. You said you're interested in this space. I want to introduce you to the founder, or whatever it is like, you're actually providing services on a regular basis to these companies that you funded, and it kind of benefits everybody, right? Because you're helping raise the value of that company and help that company get off the ground. And at the same time, on the back end, when that company sells, closes, goes IPO, whatever it is, you're going to benefit from that as well, right? But I feel like in the early days, like, you go back and you look historically at a lot of these funds, and they didn't do that. They just kind of wrote a check. And then over time, it seems to be to the point now where, like, I've heard of founders getting management consulting training, um, like going to different schools on how to public speak. I mean, like, just services after services being provided to help lift their game.
Exactly. Yeah, that is where everything has gone and is today. It's really about what value can you add to my company beyond a check. And founders really need to be asking that of the venture funds they engage with, because it's a dating game in many ways. It's a numbers game, if you will. But you can take money from anybody if they're willing to give it to you. But do you really want money from this person or that person if their reputation is very poor in the market? Do you want to have someone calling you every other week and harassing you or demanding that you take your company in a direction that you and your co-founder don't think it should go?
Yeah.
So you have to do a significant amount of diligence on them, just as they should be doing diligence on you. I mean, when I look to make an investment, I do a lot of diligence on that founder, on the team, on the traction that they've had. I certainly look deep into the industry. One company I invested in a while back that's done really well is called PSI Quantum Computing.
Hmm.
And when I first learned about what they were doing, when I met the co-founder, I was immediately intrigued. But I went straight over to some people I knew over at Harvard and MIT that that are professors in the field of quantum. And I started asking a lot of questions and I started learning a lot. And then, of course, I got to know the team a little bit more. And I didn't just rush into it overnight and just say, oh my gosh, yeah, I'm going to write a check today. I, I did good diligence and I met with the team a few times. And I really went out of my way to make sure that this was something that I had conviction in. And I
Yeah.
think founders should be sure that they have conviction in the investors in their company as well, because they need to know that those people are going to essentially ride or die with them all the way to the end.
Yeah. I mean, how much of this is word of mouth too, Ryan? Like, the company you invested in, they're doing quite well right now. Like, when you go to make an investment into another company, maybe they have heard of the work that you have done with your current company that you invested into, right? Is there a big word of mouth within the industry? Like, is it smaller than we think? I guess I should say.
It probably is smaller than we think in certain circles. In
Yeah.
others, it's not. In most cases, it's quite gilded, so it's hard to really get information.
So I have a few questions about a couple terms that you threw out there that the audience may not be familiar with. So, what is deal flow from your perspective?
From my perspective, that is the investment opportunities that you are seeing either organically or from your outreach.
Okay. So then, like, what does that mean? Does that just mean like, I'm getting a phone call from, a founder who knows another founder and thinks that I should consider looking at their company? Or is it like you're getting together with other venture firms and being presented in a large room? Like nowadays, what does that look like? Like, how do you make sure that you're getting the next Uber or something like that on your desk just as much as Mark Cuban got the phone call from the founder of Uber? You know what I mean?
Oh yeah. So okay, so that's that's really the $1 million question, and if you can answer that, you're on the inside track, and things are going to look pretty good for you. But
Okay.
the fact of the matter is even the most talented investors with the best deal flow in the world pass regularly on companies that end up outperforming a lot of their portfolio. So
Mm,
there are checks and balances for you to take when deciding what to invest in, but your network is going to definitely drive value to your opportunity set that you look at as an investor. So it pays to be on the ground, and it pays to build relationships that are centered around trust and common values. And the more you help out people within your network, the more likely they are to come to you moving forward.
yeah. I've been hearing a lot about these pitch days, and they've been going on a long time. I've actually attended a few of them, where Dee and I sat in the audience and kind of watched these new companies kind of pitch their ideas and stuff, and then we have the opportunity to advise them or work with them and that kind of stuff. And I'm seeing them pop up more and more now. So every university has a pitch day. They invite all these venture firms over to sit and watch and kind of see if they're interested in the companies and stuff. I mean, that's like getting right to the source, right? I mean, you're looking at grabbing really young, talented people right at the university, very young, right, from 18 to 22, and kind of catch them right before their idea kind of breaks out. Um, have you done any of those, and how do you feel about those happening at such a early stage in people's development?
Yeah, yes is the short answer. I've been to those events. Um, Certain universities have much more structured events around that. Some of them are catered to students at the university. It's a value add that they provide to the community on campus.
Mhm.
And then others will have accelerators that are on campus, but they're not purely driven by the student body.
Okay.
I personally like to see companies founded by people who've been out of college for a few years and have already worked somewhere and picked
Mhm.
up some true real world experience.
Yeah.
Um, Someone who's been a part of a team that has scaled a company in some capacity or another, rather than someone who's building it right in their dorm room. And there is going to be someone along the way who's building something in their dorm room that is just incredible, and it should definitely be given the time of day, and you should meet with them. So it pays to spend time at these events and to go and just be seen and be known, because even if you're not at all of these events at these pitch days that you have, if you do frequent campuses or get to know certain professors, um, when they see something that really stands out, if you have a good relationship, they might just call you and say, I've got this student. You really ought to meet with them.
Yeah.
And some universities are better at doing that than others.
Yeah, I mean, it seems like it would make a lot of sense. I know Stanford does that a lot where, they'll pick up the phone and call, a venture firm and just say, "Hey, you should come over and check out some of the stuff that these people are doing in our lab," or, that kind of stuff, just to kind of get it early, get the insights early, kind of like understand kind of what's going on. But um it's an interesting model because Dee and I have been having this debate lately, and it's kind of this kind of elephant in the room. It's a discussion that happens all the time, and I'd love to get your input on it. So tell me if I'm accurate or not, and if I'm not accurate, then fine. I just want to clarify something. So typically, if you are a venture company and you pick 10 companies, you're probably only going to be right, or I should say, super successful with a couple of them. So your success rate is somewhere around, let's say, 10%, 8 to 10%. And I know the reward on that 8 to 10% is really large in some cases, especially if the company goes IPO or something like that. But to me, that seems really small. Like with all the metrics and the data and the advisors and everyone who exists these days that can help kind of evaluate an opportunity, evaluate a team, evaluate a space, it seems like that number should be a lot higher. Like, like why is it so low? Like, why is it not like, hey, we're successful at picking companies that go big or do really well at 30% or 40%? Why is it 8 to 10%?
I think everyone is going to have their own perspective on that. From my perspective, you know, if you're if you are a fund that has a focus and you're looking at a specific industry,
Mm-hmm.
now, your opportunity set is smaller. So you're going to take more swings at bat, to use a baseball analogy,
Mm-hmm.
in hopes of getting that 8 to 10% outperformance that will return your entire fund.
Yeah.
And so you have to take calculated risk when doing so. But in some cases, you have to be able to execute fast, right? Because pace of execution wins deals. But you do want to make sure that what you are executing on is of the highest caliber. It's really challenging to do that. There is no real right way to find the best of the best. There isn't any formula that's written in a book that you could follow blindly and have it work.
But what are some of the things that you've seen through your experiences of doing this that can elevate that number, right? So like Dee and I have a prediction. So one of the things that we believe is that the stuff that we do with product experience, where we actually evaluate products, product fit in the market, and actually talk to customers and see how the customer is responding to the product itself, in some form, that data itself really kind of tells you how well this thing is going to connect with the broader audience. So, especially with a consumer facing product, right? Like we're good at doing that, and I believe that we could be very successful. We can, from an investment standpoint, be very successful just from looking at that one metric alone. Assuming that everything else is dialed in, like you have a good team and that kind of stuff. But over your time, like, have you seen certain things that you would say, when properly evaluated, could elevate the success rate to be somewhere, at 20%, 30% or higher, but maybe we're just not doing it yet?
I think we're starting to see tools come about that are able to help better predict outcomes for investments, through the use of artificial intelligence and machine learning.
Okay.
And there are some venture funds that have built their own algorithms around that selectively looks at a pitch deck before they
Mm.
even meet the founder to see if certain keywords or processes are followed in that presentation and deck to let them know if it'll be successful. And it's wild, but it's still truly unproven. But some are saying that by implementing these tactics, we have a higher probability of greater outcomes than other funds. But I don't
Yeah.
think it's really been proven out yet.
Yeah, and you know what it reminds me of is hedge funds. Is 20, 30 years ago, I was talking to somebody who's older who works kind of in that space, and he was saying that like 20 or 30 years ago, the majority of people at a hedge fund or big investment bank were people who had MBAs and were very interested in business and that kind of stuff. And they said now you go in and there's a huge percentage of people who have PhDs in mathematics from MIT,
Yeah, there's
right?
quants. They're full of quants.
Yeah, that's just it. That's just what they do. They just run the numbers all day long, and they're kind of just trying to figure out what works and what doesn't. And then a couple months ago, which I was going to send this to you, and I totally forgot, but Dee and I were reading about a company in Hollywood that actually uses AI in order to scan screenplays to try to determine if the screenplay would be successful with a given audience just by having the actual machine read it instead of actually having a typical screenwriter not screenwriter, but a screen reader, read it and try to figure out whether or not this is going to be a good fit and it should go to the next level. I mean, because that's very similar to like pitching a company as well, right? You're pitching this screenplay or this movie, and
It's similar, but like my argument on the other end of it would be it's difficult to gauge emotional reactions
yeah,
to the written word as opposed to emotional reactions to the finished product of cinematography.
yeah. No, no,
So
100%. I mean, D and I were saying the exact same thing when we were reading about it. And we actually did a podcast about it. But like we we 100% agree. But like if you kind of like align it with what you just said about like, looking at pitch decks and stuff like that, I could see how that could be challenging because you could look at it and say like this is a great opportunity for this space, but then once you've decided that okay, yeah, this is a great opportunity for this space, it could be huge, there's a huge market, there's a big TAM, whatever. Well, you need a team that can execute on that, that's going to work 12, 15 hours a day, never give up, all that kind of stuff. And how are you evaluating that, right? And then connecting that with what you're getting from your AI system that's indicating that this is a big opportunity.
yeah, because it's funny, like it will help you weed out the fat, if you will.
Yeah.
But at the same time, I see a lot of pitch decks on a daily basis, a lot. And I see a lot of garbage. And then I see some that just really stand out. And
Yeah.
occasionally you'll see one that really stands out. But if you spend the time and dig into it, it shouldn't be standing out. It's like they had someone professionally help them craft it. So the
Oh.
people behind the deck are the company at the end of the day. So you need to get to know those people. You have to speak with them. It's really helpful to meet them in person. And the deck is nice, but the deck doesn't show you the demo of the product.
Yeah. How much time do you spend communicating with founders and things like that before you would like pull the trigger and make a financial commitment?
I think it varies. There isn't a set period of time, but I have a list of metrics that I walk through to formalize my diligence.
Uh-huh.
I make sure I check off every single box on that diligence tracker of mine before I make any final decision. For me personally, I like to read something and have a conversation and sit on it for like a week and really think about it and ask myself a lot of questions. I whiteboard things, I put them down on paper, and I try and scenario plan and do my best to you know be a devil's advocate, if you will. And then I'll pick up the conversation. But I don't I will never leave a founder hanging for a month or more. I If I know it's a no, I let them know right away.
Yeah. Have you ever passed on anything that you wish you wouldn't have?
No, not yet. No, I'm
Uh,
sure I will, and I'm sure there's a possibility I probably have already. But this is a long game, so you don't always know that outcome. And to the other side of it, if a company you pass on goes out and raises a big round of money,
mhm.
doesn't guarantee their long term success.
No, it
So you
doesn't.
can't let that beat you up.
Yeah, I mean, that's a tough one. Like, the more you see, the more you start to get almost slightly confused as well, right? Because, like, went through this period where I was looking at a bunch of pitch decks, and we were assisting a venture firm and kind of thinking through products and stuff like that. And I was like, I felt like the more I read, the more I got confused, right? Meaning, like, I understood what the value proposition was, I understood what they were doing, I understood what the other people were doing, and we have a process basically for getting all your stuff organized and properly discussing each one and that kind of stuff. But if you just take a step back, I empathize with you because you end up liking a lot of them, right? You go like, oh, I really like a lot of these founders, right? I think they're really hardworking, they're super interested, this is their passion, and then you look at the pitch decks and you're like, the decks are pretty good, the products are pretty good, and you're trying to make an educated decision on what to do. And I guess my question is like how much how much of your decision is influenced by how much you actually like the founders themselves? Like even if they don't have everything dialed in the way that you want them to.
That's a good question. Sometimes it's more influenced than it ought to be. But you have to have restraint, And because at the end of the day, you are acting as a fiduciary for your limited partner.
True.
And so,
Yeah.
you have to hold back some of those personal feelings and say to yourself, if I make this investment, I'm going to have to explain it to all of my limited partners at some point in time. So do I walk away from what I have set in stone as my, you know, different forms of diligence and just say yes?
Mhm.
Or do I not? And I would say it's to your benefit to not walk away from what you've put down in stone as like check boxes that must be checked off before you get to a yes.
I see. Do you feel like you have to go to your limited partners, to get approval on certain investments, or once they have decided to fund your firm, then you don't have to really, consult with them in any way?
Yeah, once the money's in, you don't have to consult with them,
Okay,
unless there's some form of a side letter that states you need to do so.
I see.
That doesn't
So
happen too often.
So I'm curious about something else too. Is that a lot of people have asked me about this, and it's kind of a crude way of talking about it, but I just wanted to see if you can explain it a little bit. So typically, the way a venture firm gets paid, right, is they get is this correct? You get a management fee, and then obviously you own a percentage of the company that you invested into. Correct? That's the only two ways that happens. So, like for example, like all the services that the firm provides after they invest into you and all that kind of stuff, those aren't things that you necessarily charge the company for or anything like that. These are just all part of your initial investment into the company. I'm just trying to figure out how the money's made, you know what I mean, and how the money flows.
Well, I think each fund is going to have their own unique structure. There are some funds that have subsidiaries to their fund or a different company that operates as an advisory. But
Okay.
typically, they offer advisory services on a fee basis to companies that are further along and can afford
Okay.
those services. And then other funds, more established, larger funds, they might not charge you for any of that. It might just be part of their offering to you as an investor.
Okay.
The way a fund looks at earning out of just in the typical structure
Yeah.
is you've got a management fee and a carried interest percentage. And boilerplate standard is 2% management fee, 20% carried interest.
So what does the 20% carried interest mean for people who don't understand that?
So the carried interest is after the investor's money is returned, then 20% of future upside is that of the firm that made the investment.
Okay, so what would
So
be an
you
example?
continue to pay profit back to your limited partners, but once they get their money paid back, their initial investment, then like 20% of that, as it continues to rise, will
Mhm.
go to you as the fund, and then you use that to pay additional bonuses and salaries to the general partners and associates and everyone else, or
Oh, so
however you
that's
wish to do it.
so that's kind of how everyone who works for the fund gets paid.
No, most everyone who works for the fund is getting paid off of the management fee. So that kind of gets back to your earlier
Oh,
question on the size of the fund and whether or not you are a solo whether or not you're a solo partner or you have multiple partners. So a 2% management fee on $10 million is not a lot of money,
yeah.
right? 2% on $20 million is more money. But what type of salary do you want for yourself and for your partner? Because that 2% is what has to manage the entire company.
Mm, okay. So that's why when you hear about like, certain, very, very large firms having $100 billion, fund or something like that. So 2% of the 100 billion is basically funding the actual
Yeah, that
employees
that
and the.
runs that runs the operations of the firm. So a firm with like two billion in AUM, they that's over multiple funds. That's not always just one single fund, but they accrue a management fee on each fund, and they use that management fee to pay salaries and to operate the business. And then depending on how they want to run their business, in some cases you can get you can go to the bank and you can get a loan on the management fee, but you can't really get a loan on the dollars that are managed because it's just not possible. But you
So
can get a loan on the management fee because it's a set number and it's always going to be there for the lifetime of the fund.
I see. So the fund itself, though, like you said, like the lifetime of it, how long is the fund there? Like, is it until all the money has been spent? Is it, you know, typically a 5 year span or something? Like, how long do they, if I'm a limited partner and I give you $1 billion, am I expecting that you're going to spend that $1 billion in the next year? Or am I expecting you're going to spend that $1 billion over the next 10 years?
Well, that's a great question, Brian. So what you're expecting is that, we'll spend it over the lifetime of the fund, but we will call that capital during different periods of time. Typically, you're going to call capital, you know, once a year for the first 3 or 4 years, which is typically the investable period of the fund.
Hmm.
And then you invest into those companies, and then you're not investing the full $1 billion. You're probably investing, anywhere from 40 to 80% of it, depending on how your portfolio construction is done. And
I
then
see.
you're going to have, say 20% in reserves. And then you'll hold on to that reserve to follow on into future rounds.
I see. So when we're hearing right now that a lot of different funds have decided to cool off for the next 12 months, that just means that they're not calling money from the fund to make investments as much over the next 12 months.
It doesn't necessarily mean that. I mean, they may have already called the capital. They might have it already. I mean, like
Uh-huh.
right now, there's over $290 billion of dry powder from venture funds that's just sitting on the sidelines waiting to go into new companies right
Whoa.
now. So so they're cooling their jets because they're waiting for markets to adjust. They're waiting for valuations to come down. They're waiting for the dust to settle. They're waiting for bills to pass the Senate and the House, right? Like, I mean, just today, I don't think the headlines hit, but maybe it has since we've been on our podcast. But the House is set to pass the climate and healthcare bill today.
Yeah.
That's $430 billion bill, and its focuses on cutting greenhouse emissions and reducing how much money people have to pay for medicine, right? And I mean, there's something in there for a $7,500 tax credit for purchasing an EV, but the thing that makes it tough is that EV has to be assembled in North America. Not all EVs are assembled in North America. I think most of the EVs on the road are Toyotas. They're not being made here, right?
Oh,
So that's kind of a problem, but you know, it's a really big deal. $430 billion is going to go into, creating jobs, strengthening supply chains, countering China. There's a lot of good that will come out of that.
hmm.
So they're waiting for those dollars to come forward. You've also got that Chips and Science Act that just passed last week.
Yeah.
And that's going to boost American semiconductor manufacturing and design and research. That's also going to be a big driver of economic development. I think they authorized $10 billion in that Chips Act to invest in regional technology hubs in order to foster economic development and job growth. That's really good for venture and for the companies that you're investing in, because you know that there's going to be federal dollars available as well. Federal dollars can be received by these startups and it doesn't hurt them in any way.
So how do you see all this stuff? Like as someone who's looking at investments, in the moment right now. I mean, like you were telling us about a few the other day. So are you kind of a little bit hesitant and kind of waiting for these bills to pass? I know one of them already passed, but like waiting for them to pass. Are you feeling optimistic about the way things are looking? Like where's your head right now?
I'm really optimistic about where things are at. I am cautiously optimistic, but I mean, the job of a fund manager is to make investments. So sitting on the sidelines in many cases is not always the best thing to do. And you shouldn't just close your doors to close them and go on summer vacation. I mean, the door needs to be open. You need to be working. You need to be looking for those opportunities. And when you least expect it, something great might just come around the corner. So your door should always be open. But I think what they're really signaling by giving such a broad statement is that our pace of execution is slowing down
Okay.
because we're now waiting for the dust to settle. And we're also waiting for certain things to come into alignment that we think will align with our longer term objective for making investments in something that will benefit the companies we invest in. But the thing to keep in mind though is even those funds that are saying we're not investing today, they have a timestamp on them. If their fund is raised, they've got to allocate that capital and get it out the door.
I see. So when you say there's 290 billion, is that correct? You
Yeah,
said of
that's what
just money sitting on the sidelines. That's a lot of money sitting on the sidelines. Do you
it's a lot
think
of
that?
money, but it's spread that is spread across investment stage and across industry.
Yeah.
Even so, it's still a lot of money. And I think that's predominantly US based funds.
Do you predict a lot of activity in 2023?
Yeah, I think there's going to be a lot of activity in 2023.
Yeah, that's what it seems like, and that's what I'm kind of hearing. It
You're
seems
gonna,
the
I think you're gonna
opposite.
see a strong focus on industries that are driving like high wage sectors and artificial intelligence and advanced manufacturing, clean energy technology. I think that will help catalyze like regional economic growth and development in those industries. And a lot of the CHIPS Act is going to help catalyze that. This focus on climate will help catalyze that for investors who are making investments that are driven by climate or decarbonization efforts.
Like, what should founders be thinking right now? Like with all this happening, I mean, we haven't had bills like this passed in a long time. And when we talk about these, like I start to get excited when I'm hearing you talk about them. And as a founder, what should you be considering if you're in one of those segments?
I think you just have to be considering, how do you think you can contribute to humanity and make the world a better place with the company that you start?
Do venture funds care about that though? And I mean, I hate to say that, but I just sometimes feel like we went through this whole period, Ryan, where it's like it was all, I don't know, just apps like that didn't do anything, right? I'm going to fund this app. I'm going to fund that app. And all these apps they're not valuable. They just kind of suck up your time and stuff. But now I'm actually starting to see really cool companies start to emerge that are trying to like clean the ocean and do other things. Have venture firms kind of like shifted their thinking and really started to get excited about these segments more now than they did, 10 years ago when everything was all about the app on the phone?
Yeah, I think some have and others have not. I mean, there are like the biggest funds in the world have funds that are solely dedicated to gaming, like video games, and
Yeah.
solely dedicated to uh, blockchain or solely dedicated to crypto. Is crypto really gonna is it gonna make the world a better place? Some will say yes, others will say no, not at all. I mean, it's really up to it's I don't know, Brian, to be honest with you. I think some do care, and there are plenty that don't, and they just say it as a cover.
Hmm.
But if you are a fiduciary to your LP and you raise that money from your LP under under the premise that you will be investing in companies that work to decarbonize the planet, then you damn well better be doing that with your money. Because if you're not, they sure as hell aren't going to come back and fund your next fund.
True, true. And what
So
about?
I think a lot of it is tied to sector focus
Mhm.
more so than anything. So sure, there's plenty of people that are focused on sectors that are good for humanity and good for business, and then there are others who are purely driven for financial returns that are creating apps that they suck information off of people's behavior.
No, it's true, and it was nice to see that some of the areas you're interested in, is like artificial intelligence and quantum computing and things like that, because I think that's the stuff that's really going to push things to the next level. I actually saw a company the other day that basically they're using virtual reality on your eyes in order to do all of your eye exams. And the long term goal is like you'd be able to potentially do this at home, right? So you wouldn't even have to go to your eye doctor or whatever. But the quality of data and the way that after the data has been absorbed, they can analyze the data and give you a result right away about where you are on certain aspects of your eye health was fascinating. And it's took like basically 5 machines that were in a medical office and shrunk it all the way down to just a very modified and specific purpose augmented reality headset. And I looked at it and I was like, this is kind of the next level. We're actually trying to use, machine learning and things like that in order to like solve real problems, like things to, help people with their health, or to, like you said, to, help the world be a cleaner place. And that kind of stuff, exciting. Like, I'm excited to see that. So what are the areas that you are most excited about and you hope to invest in the next 5 years or so?
Yeah, I'm most interested in robots and quantum computing or artificial intelligence and cyber. I'm really interested in automation for the enterprise, and anything that's going to work on decarbonization or around the climate.
That's awesome. And so are there any companies, you don't have to say names or anything like that, that are coming down the pipeline that you're looking at that you think are going to have a pretty big impact in the next couple of years?
Yeah, there's definitely a few that I think will have a big impact on different industries. I've mentioned PsiQuantum earlier. I think that will be a real breakout winner in the long run. And they're doing some really interesting things around quantum and helping solve for some of the world's greatest problems,
That's awesome.
and also working to make their computers available to industry
Hmm.
that needs the power of a quantum computer to break through and solve for these challenging problems. And they know that it's going to the resources of quantum are going to be limited, so they want to set aside resources of their own for different industries, and they put together an initiative called q climate, so climate with a q,
Uh-huh.
and launched that at the World Economic Forum earlier this year, and are working collaboratively with a number of different industries to give them the resources they need to have early access to the power of quantum computing.
That's awesome. I mean, all this stuff sounds so exciting, but especially someone like me who gets super excited about tech anyways. I love hearing that everyone's kind of pushing the limits in those areas. And and specifically, like, hearing that you're excited and you want to put money behind this stuff, right? It's not just all talk, from a lot of people of like, oh, I'd love to see this stuff happen, but it doesn't happen unless it's funded. At the end of the day, like, there are some things in some companies that you can build without funding, but you need funding. Like, you need teams and resources and things like that in order to get things off the ground. So I'm really excited to hear that. But Ryan, I wanted to thank you so much for taking the time today to kind of dive in and talk about this stuff and answer some of our questions. And I could have sat here for 5 hours and asked you questions about this stuff. So hopefully you'll want to come back on the podcast again. And what I was thinking about it is, if you're interested in doing that, next time what I'll do is I'll talk to our users and kind of figure out what questions they have about venture capital and how it works and stuff like that. And we could do a little fun session where I'll give you the questions beforehand and then you can come in and kind of answer them and explain those different aspects for our listeners.
Yeah, I look forward to that.
Yeah, that's awesome. Well, thank you all again for taking the time to listen to us today. We really appreciate it. We'll be posting many of the links and sources and everything that either Ryan talked about or I talked about today on Twitter, at our Twitter handle at the X Podcast One. That's the X Podcast and the number one. If you like this podcast and found it interesting or informative, it helps us a great deal if you subscribe or leave a review on whatever platform you use. Thanks again, and we will see you all next week.